Higher risk always leads to higher returns. Investing is only for the wealthy. Buying a home is always better than renting or vice versa. You need a lot of money to start a business. You can rely on your provident fund for retirement. Hello, friends! Welcome back to our YouTube channel, your destination for holistic growth. Today, we're breaking down 10 common financial myths with real-life examples. Are you ready to challenge and reshape your financial understanding? Let's get started. Myth number 1. Higher risk always leads to higher returns. Let's begin with the 2008 global financial crisis. Investors around the world learned that high-risk mortgage-backed securities could lead to catastrophic losses. This example illustrates that higher risk does not always equate to higher returns, emphasizing the importance of risk management. In fact, the most successful investors like Warren Buffett have always emphasized on mitigating risk. His famous quote, "Risk comes from not knowing what you are doing," sums up that investors should thoroughly understand all risks in investments and then invest according to individual risk appetite to get the best results from their investments. Myth number 2, you should always save 10% of your income. Next, let's explore the myth that you should always save exactly 10% of your income. This idea often lacks flexibility and doesn't adapt to personal or economic changes. For a clearer understanding, let's look at Japan as a case study. Historically, Japan has seen high savings rates, but these rates have varied dramatically in response to the nation's economic conditions. During the economic boom in the 1980s, Japanese households saved a large portion of their income due to economic stability and a culture that favored frugality. However, as the economy stagnated in the 1990s and beyond, savings rates declined. This shift was because real wages fell and the population aged, leaving less disposable income for savings. This example demonstrates why it's important to adjust your savings rate based on your financial situation, goals, and broader economic environment. Tailor your savings strategy to your unique circumstances to ensure it supports your long-term financial health. Myth number 3. Investing is only for the wealthy. Let's debunk a very common myth now. Investing is only for the wealthy. The truth is, investment opportunities are no longer exclusive to those with large amounts of capital. The Indian financial landscape has dramatically transformed, especially with the advent of technology in finance. During the COVID-19 pandemic, for instance, we witnessed a surge in retail investing in India. Mutual funds have made it possible for everyday individuals to start investing with minimal amounts, sometimes as little as rupees 500. Platforms like YouTube provide educational resources that make investing accessible for beginners. This democratization of investing means that financial growth through investments is now achievable for a broader section of society. By investing small amounts regularly, individuals can gradually build a substantial portfolio over time, proving that you don't need to be wealthy to start investing. You just need to start. Myth number 4. Buying a home is always better than renting or vice versa. While owning a property is a significant goal for many, it's not always the best financial decision for everyone at every stage of life. Consider the differing property markets in cities like Mumbai versus Bangalore. In Mumbai, where real estate prices are sky high, buying a home can tie you up in a massive mortgage and deplete your liquidity, making it a less favorable option for those who value financial flexibility or whose job requires them to be mobile. Renting in such cases offers less financial burden and more flexibility to move. Conversely, in cities like Bangalore, where property prices might be more stable, the long-term benefits of buying could outweigh renting. Additionally, the US housing bubble burst in 2008 serves as a global cautionary tale. It showed that market conditions can change drastically, and investing in real estate isn't always as safe as it seems. The key takeaway, whether to rent or buy, should be based on personal circumstances, financial stability, job security, and market conditions. Myth number 5. You need a lot of money to start a business. This is simply not true in today's world. Let's delve into the story of Infosys, one of India's biggest technology companies, which was started by 7 engineers with just approximately rupees 10,000 in 1981. Fast forward to today, and Infosys stands as a testament to how far innovation, vision, and dedication can take you, not just capital. In the digital age, the startup landscape has evolved dramatically. The internet has lowered entry barriers and reduced the need for huge initial capital. Entrepreneurs can now start online businesses, develop apps, or offer freelance services with minimal upfront costs. Platforms like Amazon and Flipkart allow sellers to reach nationwide audiences without needing physical stores. Moreover, digital marketing tools can provide cost-effective ways to promote businesses to global audiences. The key takeaway here is that while starting capital can help, it's not the primary determinant of success. Innovation, strategic planning, and the ability to adapt are equally, if not more important. This myth should not deter aspiring entrepreneurs who have great ideas but limited funds. Myth number 6, debt is always bad. It's important to differentiate between good debt and bad debt. Good debt is an investment that will grow in value or generate long-term income. For instance, taking a loan to pursue higher education or to buy a home can be considered good debt. These are investments in your future that typically appreciate over time or enhance earning potential. Take the example of Tata Motors acquiring Jaguar Land Rover in 2008. This strategic move, financed partly through debt, revitalized the struggling British brand and boosted Tata Motors' profits in the long run. On the other hand, bad debt involves borrowing money for depreciating assets or expenses that don't provide a return, like high-interest credit card debt used for everyday consumption. This type of debt can spiral and lead to financial instability. Understanding the difference and managing debt wisely is crucial to maintaining and enhancing your financial health. By leveraging good debt responsibly, you can invest in your future success without the negative connotations typically associated with borrowing. Myth number 7. You can rely on your Provident Fund for retirement. While the Provident Fund is a cornerstone of retirement savings for many Indians, relying on it exclusively is risky. As life expectancy increases, so does the amount of money needed to sustain a comfortable lifestyle post-retirement. Inflation, healthcare costs, and changing living standards can make the savings in your Provident Fund insufficient over long retirement periods. For instance, consider the impact of inflation on retirement savings. If inflation averages 5% annually, the cost of living will roughly double in about 14 years, significantly diminishing the purchasing power of your Provident Fund by the time you retire. Therefore, it's crucial to diversify your retirement portfolio. Options like mutual funds, stocks, and real estate not only provide potential for higher returns, but also offer a hedge against inflation. It's about creating a multifaceted investment strategy that considers various income streams, ensuring a stable and sufficient retirement fund that keeps pace with economic changes and personal needs. Myth number 8. Keeping money in the bank is the safest investment. While bank deposits are safe in terms of preserving capital, they may not always be the best choice for growing your wealth, particularly over the long term. The key issue here is inflation. Let's break it down. If the annual inflation rate is 6% and your bank account earns only 4% interest, your savings are effectively losing value each year, as the purchasing power of your money diminishes. For example, in the early 2000s, India experienced inflation rates that consistently outpaced the interest rates provided by bank savings accounts. This period demonstrated that those who relied solely on bank savings saw their wealth erode in real terms. Therefore, it's crucial to consider investments that can at least keep pace with inflation, or ideally exceed it. Options like mutual funds, stocks, or government bonds offer potential for higher returns. These investment vehicles can help maintain and even increase the purchasing power of your savings over time. Myth number 9. You shouldn't invest during a market downturn. While it may seem counterintuitive to invest when the market is falling, downturns can present significant buying opportunities. During these periods, many solid stocks are undervalued, offering a chance to purchase at a lower price and benefit from the eventual recovery. For instance, consider the global financial crisis in 2008. Post-crisis, markets worldwide plummeted, but those who invested in fundamentally strong companies during the downturn saw substantial returns as the market recovered. Similarly, during the COVID-19 pandemic, the initial market slump in early 2020 led to a sharp decline in stock prices. However, investors who recognized the opportunity and invested in sectors that were poised for recovery, like technology and healthcare, benefited greatly as these sectors surged in the following months. Investing during a downturn requires careful analysis to identify companies with strong fundamentals that are likely to withstand the economic stress. It's not about timing the market perfectly, but recognizing the potential for long-term growth despite short-term volatility. Diversifying your investments and maintaining a long-term perspective are key to navigating these periods effectively. Myth number 10. Financial planning is only required when nearing retirement. This is a misconception that can prevent individuals from maximizing their financial potential throughout their lives. Financial planning should be a lifelong process that adapts to your changing needs and goals at different stages. For example, consider the financial needs of a young professional just starting out. Setting up an emergency fund, paying off student loans, and beginning to save for a down payment on a home are immediate needs that require early financial planning. As you move into midlife, your focus might shift towards saving for your children's education, investing in property, or starting a business. Each of these goals requires distinct strategies and financial resources. Finally, as you approach retirement, the focus turns to ensuring you have enough funds to live comfortably in your non-working years. But if you wait until then to start planning, you might find yourself playing catch-up. Starting in your 20s versus your 40s can significantly affect the power of compounding returns. Thus, starting early and updating your financial plan regularly to reflect your current circumstances and future aspirations is crucial. It's not just about setting up for a distant retirement, but ensuring financial security and achieving goals at every stage of life. So there you have it, my friends. 10 financial myths, debunked with practical examples. If this video enlightened you, don't forget to like, subscribe, and share the knowledge with friends and family. Until next time, stay healthy and happy investing.